The Intelligent Investor by Benjamin Graham, a cornerstone in the world of investing, offers timeless wisdom and principles for investors. Value investing philosophy. Graham advocates for a conservative, disciplined approach to investing, emphasizing the concept of value investing. He suggests that investors should seek out stocks that are trading below their intrinsic value, focusing on fundamental analysis rather than short-term market trends. Margin of safety. One of Graham's central concepts is the margin of safety, which refers to the difference between the intrinsic value of a stock and its market price. By purchasing stocks with a sufficient margin of safety, investors can protect themselves against downside risk and increase the likelihood of long-term success. Market analogy. Graham introduces the metaphor of Mr. Market, representing the irrational and emotional behavior of the stock market. Investors should view Mr. Market as a business partner rather than a guide, taking advantage of his occasional mood swings to buy low and sell high. Defensive versus enterprising investors. Graham distinguishes between defensive investors, who prefer a passive, low-risk approach, and enterprising investors who are willing to put in more effort and take on additional risk in pursuit of higher returns. He provides tailored advice for each type of investor, emphasizing the importance of aligning investment strategies with individual temperament and goals. Importance of education and discipline. Throughout the book, Graham stresses the importance of education, discipline, and patience in the world of investing. He encourages investors to conduct thorough research, avoid speculation, and adhere to a long-term investment strategy based on sound principles rather than market sentiment. Overall, The Intelligent Investor offers a comprehensive framework for building wealth through prudent, value-driven investing, making it essential reading for investors of all levels. Benjamin Graham's value investing philosophy, as outlined in his seminal work, The Intelligent Investor, revolves around the following key principles. Intrinsic value. Graham emphasizes the importance of determining the intrinsic value of a stock, which represents its true worth based on fundamental factors such as earnings, assets, and growth prospects. Value investors seek to buy stocks trading below their intrinsic value, believing that over time, market prices tend to converge with intrinsic value. Margin of safety. Central to Graham's approach is the concept of the margin of safety. This refers to the difference between the intrinsic value of a stock and its market price. By purchasing stocks with a significant margin of safety, investors can cushion themselves against unforeseen events or errors in their analysis, reducing the risk of permanent capital loss. Contrarian thinking. Graham encourages investors to adopt a contrarian mindset, being willing to go against the crowd and take advantage of market inefficiencies. Instead of following market trends or succumbing to emotional reactions, value investors focus on undervalued stocks that have been overlooked or unfairly discounted by the market. Long-term perspective. Value investing is inherently a long-term strategy. By holding on to quality investments for extended periods, investors can benefit from the compounding effect and ride out market volatility. Emphasis on fundamental analysis. Graham advocates for rigorous fundamental analysis of companies, examining financial statements, earnings history, competitive positioning, and management quality. By conducting thorough research, investors can gain insights into a company's intrinsic value and make informed investment decisions based on objective criteria rather than speculation. Overall, Graham's value investing philosophy promotes a disciplined, rational approach to investing, grounded in fundamental analysis and focused on long-term wealth creation. It emphasizes the importance of patience, diligence, and independent thinking in navigating the complexities of the stock market. The concept of margin of safety is a cornerstone of Benjamin Graham's value investing philosophy, elaborated upon in his book, The Intelligent Investor. Here's a closer look at what Graham meant by this principle. Definition. The margin of safety refers to the difference between the intrinsic value of a security, such as a stock, and its market price. In essence, it represents a buffer or cushion that protects investors against unexpected downturns in the market or errors in their own analysis. Protection against losses. Graham emphasized the importance of investing in securities with a significant margin of safety to minimize the risk of permanent capital loss. By purchasing assets at prices well below their intrinsic value, investors create a safety net that can absorb adverse events or changes in market conditions. Preservation of capital. Graham believed that the primary objective of investing should be the preservation of capital rather than aggressive speculation for quick profits. A robust margin of safety provides investors with a sense of security, allowing them to withstand temporary market fluctuations without succumbing to panic selling. Risk management. The margin of safety serves as a risk management tool, enabling investors to assess and mitigate potential risks associated with their investments. By demanding a margin of safety, investors build a margin of error into their decision-making process, reducing the likelihood of suffering significant losses. Long-term value creation. While the margin of safety provides protection against downside risk, it also offers the potential for long-term value creation. As market prices gravitate toward intrinsic value over time, investors who bought with a sufficient margin of safety can realize substantial gains when the market recognizes the true worth of their investments. Overall, Benjamin Graham viewed the margin of safety as a fundamental principle of prudent investing, essential for safeguarding capital and achieving sustainable returns over the long term. It underscores the importance of discipline, patience, and rationality in navigating the uncertainties of the stock market. Contrarian thinking, a concept advocated by Benjamin Graham, involves going against prevailing market sentiment and trends. Here's an overview of how Graham approached contrarian thinking. Opposing the crowd. Graham believed that investors should be wary of following the herd mentality prevalent in the market. Instead of being swayed by popular opinion or short-term trends, contrarian investors seek opportunities in stocks that are undervalued or overlooked by the majority. Identifying mispriced securities. Contrarian thinking involves identifying securities that are trading below their intrinsic value due to temporary factors or market irrationality. Graham emphasized the importance of conducting thorough fundamental analysis to uncover these mispriced opportunities. Exploiting market inefficiencies, Graham viewed the stock market as inherently inefficient, prone to overreactions and emotional swings. Contrarian investors capitalize on these inefficiencies by buying when others are selling and selling when others are buying, taking advantage of discrepancies between market prices and intrinsic values. Margin of safety. Contrarian thinking aligns closely with Graham's concept of the margin of safety. By investing in undervalued stocks with a significant margin of safety, contrarian investors protect themselves against downside risk and position themselves to profit when market sentiment eventually shifts in their favor. Long-term orientation. Contrarian investing is often a long-term strategy that requires patience and discipline. Graham advised against trying to time the market or chasing short-term gains, emphasizing the importance of focusing on the underlying fundamentals of businesses and holding on to investments through market fluctuations. Overall, contrarian thinking, as espoused by Benjamin Graham, encourages investors to think independently, challenge consensus views, and seek out opportunities that others may overlook. It embodies a disciplined, value-driven approach to investing that prioritizes long-term success over short-term market noise. Benjamin Graham emphasized the importance of adopting a long-term perspective in investing. Here's a breakdown of how Graham approached this aspect. Focus on fundamentals. Graham believed that investors should focus on the fundamental value of the businesses they invest in rather than short-term market fluctuations. By analyzing factors such as earnings, dividends, and balance sheets, investors can identify companies with strong long-term prospects. Avoid market timing. Graham cautioned against trying to time the market, as it's notoriously difficult to predict short-term price movements with consistency. Instead, he advocated for a buy-and-hold strategy, where investors maintain their positions in quality stocks over extended periods, allowing time for the market to recognize their true value. Value investing. Graham's approach to investing was rooted in the principles of value investing, which involves buying stocks trading below their intrinsic value. This strategy typically requires patience, as it may take time for the market to reflect the true worth of undervalued stocks. Embrace volatility. Graham viewed market volatility as a natural part of investing and advised investors to remain calm and rational during periods of fluctuation. Rather than reacting impulsively to short-term price movements, he encouraged investors to stay focused on their long-term investment goals. Compound returns. Graham recognized the power of compounding returns over time. By reinvesting dividends and allowing investments to grow over the long term, investors can harness the exponential effect of compounding to build substantial wealth. Overall, Benjamin Graham's emphasis on a long-term perspective underscores the importance of patience, discipline, and a focus on fundamentals in achieving investment success. By taking a long-term view, investors can weather short-term fluctuations and position themselves for sustainable growth and wealth accumulation.